Welcome back to the deep dive. This is the show where we take that whole stack of sources you have, the heavy accounting textbooks, the really complex research papers, even those viral personal finance videos, and we try to boil them all down into something you can actually use.
And today's mission, I think, is a really vital one. We are diving headfirst into that messy world where corporate finance ideas meet your personal wealth.
Right.
We are going to decode the, frankly, very confusing world of assets and liabilities. The goal here is to separate what feels valuable from what actually builds your net worth.
And that's the core conflict, isn't it? We have to tackle this right away. These words, asset and liability, they weren't really made for us. They were created for corporations.
Exactly, for a balance sheet.
For a balance sheet to define what a business owns and what it owes. But then we try to jam them into our personal lives, and suddenly we're stuck in these endless, super frustrating debates. The classic one being, is my house an asset?
And that confusion is, it's completely justified.
Huh?
All the sources we looked at basically agree on this point, this simple common sense idea of an asset just being something good.
Yeah.
Well, financially, that's often just not accurate.
So we need to be more precise.
We need precision.
Yeah.
We need to actually clarify the mechanics of how this all works.
Okay, let's do it. So let's lay the foundation. We have to start with the most fundamental concept in all of finance, right? The accounting equation.
Mm-hmm.
In the business world, it's assets equals liabilities plus equity. It's this perfect, elegant equation that balances a company's entire universe.
Right. Everything has to equal zero at the end of the day.
Yeah.
And when we take that concept and we bring it over into our personal world, it simplifies, and it simplifies beautifully. It becomes your ultimate personal scoreboard.
Okay.
Because equity for a person, that's just your net worth. So we get this really simple formula. Net worth equals assets minus liabilities.
That's it. That's the scoreboard.
That's the scoreboard. And really, every single financial decision you make should be measured against how it impacts that one simple subtraction problem.
But to really understand that score, to really gauge it properly, we found that you need two different ways of looking at it, two separate lenses.
Yeah, that's a great way to put it.
So the first one is the balance sheet lens. This is, the paper value. It's a static snapshot, like a photo taken on December 31st, that tells you what you own and what you owe at that exact moment.
And the second lens is the cash flow lens. This is the dynamic part.
Yeah.
This is your monthly reality. It's constantly moving.
It's the video, not the photo.
Exactly. It answers that one critical question. Does this thing put money in my pocket, or does it take money out of my pocket? And you absolutely must look through both of those lenses to get the real, non-stressful picture of your financial health.
So, yeah, that's our starting point.
All right, so let's start with the most basic rule, the one for, daily financial literacy. Some of our sources call this the pocket test.
I like that one. It's simple. Assets put money in your pocket. Liabilities take money out of your pocket.
It's a fantastic, really quick definition. It's great for day-to-day, but, and this is a big but, to avoid all the confusion later, we first have to kind of confront the formal, the precise, and let's be honest, the sometimes really dense accounting language.
Okay,
That's where the confusion comes from, so we have to understand why it's so hard to pin these things down.
let's do it. Let's unpack the jargon. So how does a formal accounting textbook define an asset?
Okay, so formally, an asset is defined as, and this is a mouthful, a probable future economic benefit obtained or controlled as a result of past transactions.
Wow, okay. Yeah, that's a lot.
I know it sounds super formal, but every single word in that definition really, really matters.
Okay, so which keywords should we be zeroing in on there?
There are two that are absolutely critical. The first one is probable.
Probable.
The future is always uncertain, right?
Mhm.
So accountants, they have to constantly estimate. Think about a business and its accounts receivable. That's the money owed to it by its clients.
Right, the invoices they've sent out.
Exactly. You have to estimate that some small percentage of those clients might just go bankrupt,
Mm-hmm.
or they might fail to pay for some other reason, which means you can only list that benefit, that future cash, as probable, never guaranteed.
That makes so much sense. It connects directly to, the risk assessment you do in your own life. If someone owes you money, that IOU is an asset, but its value really depends on the probability that they're actually going to pay you back.
100%. Okay, so the second key word is control.
Control.
You don't necessarily need the legal title, like the deed to a house,
Yeah.
but you have to have the ability to stop other people from using that asset's value. And you have to be able to leverage it for yourself.
Can you give an example of that?
Sure. Let's say you have this amazing idea for a new invention. It's brilliant.
Yeah.
But if you haven't patented it, if you haven't secured that intellectual property, you don't actually control the asset yet.
It's just an idea.
It's just potential. It's not a recordable asset on your balance sheet until you control its future economic benefit.
That level of detail really shows why this stuff gets so tricky. Okay, so let's look at the flip side now. What's the formal definition of a liability?
A liability is defined as, again, get ready, a probable future sacrifice of economic benefits arising from present obligations to transfer assets or provide services in the future.
Okay, that one feels even heavier. What are the key words there?
The first one is present obligation. The duty to pay has to exist right now because of something you did in the past.
Like signing a loan.
Signing a loan, buying something on credit, contracting to deliver a service, you've created the obligation. And the second key part is future sacrifice. You are committed today to give up something valuable later, which almost always means cash. The obligation is set in stone, even if, the exact timing of the payment is a bit flexible.
Okay, so let's try to synthesize this for everyone listening. An asset is something you control right now that has value and can give you some kind of future benefit. That could be income, it could be resale value, or even just a useful service like your car giving you a ride to work. And a liability is a present obligation, something you owe now or you're guaranteed to pay later because of something you already did.
It's a perfect summary. And now that we have those two pillars defined, we need to quickly classify the different types of assets because they are definitely not all created equal when it comes to building wealth.
Right. So first, we can split them into the physical and the non-physical. So you have tangible assets. These are physical things you can actually touch,
Like what?
like land, equipment, cash in your hand, inventory for a business, things that exist in the real world.
And then you have intangible assets, which are non-physical, but they're still controlled, they're still valuable, and they can still generate future income.
Okay, so what would be an example there?
This would be things like a company's brand name, patents, copyrights, and a really crucial one, royalty rights. Think about a musician. If they own the copyright to their songs, that piece of intellectual property is an intangible asset, and it's generating a probable future economic benefit every time someone streams that song.
Got it. And that brings us to another split, which is between financial assets and real assets. This is where that difference between value and price becomes so important.
Yes. So real assets have what's called an intrinsic value. That's their fundamental underlying worth, kind of independent of what the market is screaming about on any given day.
So real estate, commodities like gold or oil.
Exactly. Their value is inherent in their physical existence or their utility. Financial assets, on the other hand, they get their value from contractual claims and whatever the market trading price is. So we're talking about stocks, bonds, mutual funds.
And this is where it gets really interesting for anyone trying to invest, right? Our sources kept pointing out that the most successful investors, people like Warren Buffett, they spend all their time trying to find the intrinsic value of a company before they buy its financial asset, its stock.
And the reason for that is so simple, but so powerful. The market price can be, well, completely irrational. It can be driven by fear or greed. So if you can figure out, or at least approximate, the intrinsic value of a stock, what that company is actually worth based on its real assets and its potential for future cash flow, and the market is currently selling it for less than that,
You found a bargain.
you have a very high probability of making a profit when the market eventually, comes to its senses. You are literally buying a dollar bill for 50 cents.
But how does an everyday person, someone who isn't a full-time accountant, even begin to approximate that intrinsic value?
You don't need to be an expert. You can look for obvious signs of, underlying strength. Does the company have a lot of hard, tangible assets? Like, do they own a lot of land or factories? That provides a sort of floor to their value.
Safety net.
A safety net, exactly. And does the company generate high, stable earnings, consistent profits? Because those earnings create a really reliable expectation of a probable future economic benefit. It's all about applying that formal test, just in a more common sense way.
Okay, let's talk about speed. Once you have these assets, you need to know how fast you can turn them into cash if, an emergency pops up. This is liquidity.
Right. Liquidity is simply the ease and speed with which you can convert an asset into cash without taking a big hit on its value.
So things like publicly traded stocks would be highly liquid.
Very liquid. You can sell them in seconds on a weekday. But real assets, like your house or a piece of art, they're very illiquid. They take time, they have fees, there's a ton of paperwork to sell them, and all of that can impact the final cash value you walk away with.
And this whole speed test gives us the accounting time horizons, current versus non-current.
Right. So current assets are the ones you expect to convert into cash or use up within 1 year. This pile of assets represents your immediate ability to pay your bills, your solvency.
And current liabilities.
Those are the obligations that are due within 1 year. These are the immediate pressures on your cash flow, your credit card bill, your utility bills, and then non-current assets and liabilities are just the long-term commitments, things held or due after more than 1 year. Your 30-year mortgage is the classic non-current liability.
Okay, finally in this section, let's try to tackle that estimation game that's required for long-term assets. I'm talking about depreciation and amortization. This area scares a lot of people, but it's so important for getting a true picture of an asset's value over time.
It really is. And it's a mechanism that was born entirely out of the need to estimate. Assets, especially the tangible ones like machinery or a delivery van for a business, they lose value as they get used over time.
Wear and tear.
Wear and tear. So accounting rules require us to estimate an asset's useful economic life, which is a key phrase. It's often an estimate that's much shorter than its actual physical life.
Let's use a business example to make that concrete. Let's say a company buys a big machine for $100,000, and they estimate that its useful life for generating revenue is 5 years.
Okay, so they might use the simplest method, which is called straight-line depreciation. They just reduce the asset's value on their books by $20,000 a year. That's the $100,000 divided by 5 years.
And that $20,000 is recorded as an expense, right?
Yes, it's recorded as an annual expense on their income statement. This shows that the asset is being consumed to help generate revenue. And here's the magic part. It reduces the company's taxable income.
Wait, hold on. So the machine is still physically there, it's still working, but its reported value on the books is going down, and that decrease actually acts as a tax shield.
That is the genius of depreciation. It's what's called a non-cash expense. It's not like you're writing a check to depreciation, but it recognizes the economic reality of wear and tear, and it directly reduces the amount of profit you pay taxes on.
Are there other ways to do it?
Oh, yeah. There are also accelerated methods, like the double declining balance method, which let a company claim a much bigger depreciation expense in the early years of an asset's life. This pushes those tax benefits forward in time.
So even if we as individuals don't formally calculate depreciation on our tax returns for, say, our personal car, we should still be thinking this way.
You have to.
If I buy a laptop for my side hustle, I need to mentally account for the fact that in 3 years, it's going to be basically worthless for professional use. I've consumed that asset.
Precisely. And the very same principle applies to those intangible assets we talked about, patents, copyrights, and so on. But for intangibles, we just use a different word. We call it amortization.
So it's the same concept, just a different name.
Exactly. You decrease the value of that patent over its legal or estimated useful life. The big takeaway here is that these systems exist because the future economic benefit of any long-term asset is inherently uncertain, and accounting uses these structured estimates to try and simplify that uncertainty right now.
That makes perfect sense. Okay, now that we have all these sharp, precise definitions, I think we're finally ready to tackle the biggest points of confusion in personal finance, where that balance sheet lens just clashes violently with the cash flow lens. Okay, let's just jump right into the biggest one, the one everyone argues about. The house debate. We have to use both of our lenses at the same time for this. Is the home an asset or a liability?
Okay, so if we look through the balance sheet view, the home is, without a doubt, an asset.
No question.
No question. It's controlled by you, and it has a probable future economic benefit, which is primarily its resale value. The mortgage you used to buy it is just as clearly a liability.
And the difference between the two is your equity.
The difference between the home's current market value and the mortgage you still owe is your home equity. And that equity contributes directly to your net worth number.
So on paper, on that static snapshot, it's a wealth builder.
Yeah.
But if we switch lenses to the cash flow view, why does it so often feel like a massive burden?
Because the home you live in is a powerful, relentless cost center. It is constantly creating these massive, non-optional monthly outflows of cash that go way, way beyond just paying back the loan principal.
You're talking about PITI.
CITI.
Yep.
Principal, interest, taxes, and insurance. Plus, and this is the one people forget, the ongoing, never-ending need for maintenance and completely unexpected repairs.
The sources we looked at showed that people consistently dramatically underestimate those maintenance costs. What are some of the sneaky major costs that just pull money out of your pocket?
Oh, think of the big-ticket items. The things that don't happen often but are absolutely massive when they do. A new roof,
That's a huge
a
word.
new HVAC system,
Yeah.
foundation work, or even just your property taxes suddenly skyrocketing after a reassessment.
Okay.
Unless that house is actively generating rental income for you, all of those outflows make it behave like a persistent, cash flow negative expense.
You're consuming a service.
You're consuming the service of housing, and it is costing you dearly every single month.
Okay, so let's try to use that clean teaching script from the sources to just settle this argument for our listener. On paper, the house is an asset because it has resale value that builds equity.
In monthly life, the house can behave like a cost because it pulls money out. You have to respect both of those realities at the same time.
Exactly. It forces you to see the whole picture. You can be house rich on that balance sheet, but totally cash poor in your daily life. And that means a high net worth doesn't necessarily translate into a low stress life.
That is the crucial distinction.
Okay, next big confusion, the car debate. Is my daily driver, the car I use to get to work, an asset?
Well, yes, on the balance sheet, technically it is an asset. You can sell it, so it has a resale value. You control the benefit of transportation. But in real life, for almost everyone, most cars are the ultimate depreciating consumption asset. They lose value at a staggering rate, sometimes 20% or more the second you drive it off the dealer's lot.
Okay, I want to push back on this a little bit based on some of the critiques we read. For someone who absolutely needs that car to get to their job 50 miles away, isn't the service it provides an essential, measurable economic benefit? I mean, how do we calculate the opportunity cost of not having that asset? You couldn't earn an income.
That's an excellent point, and it's a very fair critique.
Right.
It's absolutely an enabling asset. It enables you to deploy your human capital and generate income.
Right.
However, in purely financial terms, we have to measure the cost of that enablement. The vehicle itself is decaying in value rapidly, while at the same time is just draining cash for fuel, insurance, maintenance, repairs.
The list goes on.
It's endless.
Oh, wow.
And if you had taken all the money you spent on that car alone and the depreciation and instead invested it into a productive financial asset like a stock or a REIT, the return would be massive. That difference is the opportunity cost.
So the goal isn't to eliminate the consumption asset, because for many people that's impossible. The goal is to minimize its drag on your net worth. You do that by buying the most reliable, cost-effective vehicle you can, which then allows the rest of your capital, your money, to be invested in things that actually appreciate.
Precisely. You want to minimize the cost of enablement.
Okay. Now let's move on to the genuine wealth builders for most people. Stocks or shares in a company.
Yes, stocks are really the foundation of long-term personal wealth building. And we can define them really simply. When you buy a stock, you're just buying a tiny fraction, a tiny percentage of ownership in a company.
You become a part owner.
You become an associate, a part owner, and you are now entitled to a slice of that company's future profits.
Let's use our house and brick analogy here to make this super clear for everyone.
Okay, so imagine a giant corporate headquarters building, and it's built with 100 million bricks. If you go out and you buy one single share of that company's stock, it's like you've bought one of those 100 million bricks.
So I own 1/100 millionth of the building.
You own one part in 100 million of that building, and more importantly, of the business that's run inside it. You are entitled to that slice of the ownership.
And what are the two ways that my little slice, my one brick, can make me money? The first way is the most common one, which is capital gain.
Right. This is based purely on market supply and demand. You buy your one brick for $5. If the company does well, or if public excitement about its future earnings increases, the price of that brick might rise to $7. You sell it, and you realize a $2 capital gain.
So this method is more volatile. It relies a lot on predictions and market sentiment.
Very much so. But the second way is the passive income builder. Dividends.
Ah, yes.
Dividends are simply distributed profits. If the company makes $1 million in profit and you own 1% of the company,
I get 1% of that profit.
you are entitled to 1% of those profits, which are paid out to you in cash, usually every quarter. This is your share of the actual income generated by the company's real-world operations, and it's totally distinct from the day-to-day fluctuation of the stock price.
Okay, so moving beyond physical and financial assets, let's address the elephant in the room that traditional accounting often just ignores. Knowledge as an intangible asset, or as the academics call it, human capital.
This is absolutely essential for everyone listening. Your knowledge is a real, intangible asset because it fundamentally increases your income potential. It increases your future earning capacity.
Let's go back to the business model to explain this. A successful marketing agency, for example, its main asset isn't its desks or its computers, it's the collective knowledge of its employees.
Right.
The skilled coders, the data analysts, the expert salespeople. The company views the knowledge of its team as the asset that they leverage to generate profit.
Hmm.
The payroll is just an expense to maintain that productive asset.
And when you apply that to yourself, you are the asset. When you learn a highly valuable skill, whether that's advanced programming or complex negotiation, or becoming an expert in some niche software, that translates directly into higher pay.
Because businesses need that skill.
Because entrepreneurs need that specialized knowledge to grow their own balance sheets. They will pay a premium for it.
Okay, so this brings us to what we're calling knowledge gap one. If our human capital, our skills, are the engine that drives all of our future cash flow and our ability to buy other assets, why does accounting traditionally keep it completely separate from the net worth calculation?
Yeah, it's a huge question.
And how should a modern personal balance sheet maybe start to quantify this asset more effectively?
Well, the traditional reason it's excluded is because you can't really sell your skill set. Not like
Yeah.
you can sell a patent or a machine. There's no clear market price for it.
You can't put it on eBay.
You can't put it on eBay. Exactly. But conceptually, we absolutely should try to quantify it. One academic way to do this is to calculate the present value of your future earnings. So you'd estimate all the income you're likely to earn over your entire career based on your current skills, and then you discount all that future money back to what it's worth in today's dollars.
That sounds incredibly complex. I mean, is there a simpler way to think about it?
A much simpler way is to look at it through the lens of investment cost. Think, how much did I invest in my education, my training, my certifications? And that's an investment of both time and money.
Right.
And then ask, what is the dividend from that investment? What is the measurable, consistent increase in my salary that investment is now generating? This reframes your education not as an expense that's gone, but as an investment that created a perpetual high-yield asset for you.
I love that. So you're distinguishing between an asset-producing skill and, I don't know, a consumption skill, like learning a hobby.
That is the key distinction.
That's a really powerful insight. Okay, let's shift now to the practical framework that can help us incorporate all this knowledge into our daily financial lives. So we've established pretty clearly that just labeling things asset or liability isn't really enough for personal finance. It completely misses that crucial cash flow reality. So we need to bridge that gap.
Yes, and this is where a really practical tool comes in. It's the 2x2 classification system. It's so useful because it combines the balance sheet status of an item with its cash flow status.
So it gives you 4 clear categories for everything you own or owe.
Exactly.
Okay, so dimension 1 is the balance sheet status, asset versus liability. Simple enough. Do you own value or do you owe a payment?
Right. And dimension 2 is the cash flow status. Is it cash flow positive or cash flow negative? So does it reliably bring money in or save you money, or does it cost you money every month?
Okay, let's run some examples through that matrix. Where would a rental property that's fully paid off fit?
That's the ideal category. That's an asset, and it's cash flow positive, is putting money in your pocket every single month.
Okay, what about the home you live in?
Typically, that's an asset on the balance sheet, but it's deeply cash flow negative because of all those costs we talked about. Taxes, interest, maintenance.
And credit card debt.
That's the absolute worst category. It is a liability, and it is definitively cash flow negative. It's pulling money out of your pocket, and it's growing aggressively while it does it because of interest.
What about something simple, like a high-yield savings account?
That would be an asset, and it's technically cash flow positive. It might be a very small amount of interest, but it is putting something in your pocket, and critically, it's highly liquid. This framework just forces you to see where your wealth is actually being built or where it's being drained away.
Okay, let's move over to the liability side of the sheet. We need to spend some real time on the detailed liabilities that trap people. We all know the common ones, but the real traps are those sneaky ones that people just ignore until it's way too late.
All right, the major categories are pretty straightforward. You have short-term debt, like your credit card balance or unpaid bills, and you have long-term debt, like a mortgage or student loans. But it's the hidden liabilities that inflate your risk without you even realizing it.
Okay, so what's the first one?
First is just understanding the mechanics of high-interest debt. The liability isn't just the current balance you see on your statement. It's the massive amount of accrued interest that is waiting to be charged if you don't pay that full statement balance off.
Mm.
That obligation is already in motion.
And the housing debt market has some of the absolute sneakiest risks, right? Specifically things like adjustable rate mortgages or ARMs.
ARMs are so problematic because they lure you in with a really low introductory teaser rate for a fixed period, maybe 5 years.
Right.
But then after that period, the rate resets or adjusts based on some market benchmark plus a set margin. If interest rates in the wider economy have shot up in those 5 years, your monthly payment can absolutely skyrocket.
So what felt like a manageable cash flow negative situation can suddenly become a complete disaster.
A disaster. You have to treat the risk of a future rate hike as an immediate liability that you need to plan for right now.
And what about balloon payments?
Oh, a balloon loan is even scarier. It requires you to make a huge lump sum payment at the very end of the loan term. Sometimes you're only paying small interest-only payments for years.
And you just assume you'll refinance before that big payment is due.
Everyone plans to refinance. But if the market changes or your credit score drops or lending standards tighten, you might not be able to. And then that massive principal payment becomes an unavoidable liability that can lead to foreclosure or financial ruin. It's a huge gamble.
And maybe the biggest sleeper hit of all is the cosign loan, or any financial guarantee you sign for someone else.
You are literally creating a liability for yourself without receiving any of the corresponding asset. It's all risk, no reward.
Because if the main borrower, say your friend or relative, fails to pay,
That debt immediately shifts from being some remote potential problem to being an immediate full-blown liability on your balance sheet. You are now legally on the hook for the entire amount. Never ever co-sign a loan unless you are fully prepared and able to pay it off yourself from day one.
speaking of these complex obligations, let's try to simplify a really technical accounting area, accruals and estimates, because liabilities, just like assets, often rely on judgment and estimation.
Yes, let's go back to our friend Larry, the restaurant owner, but let's connect this back to our personal balance sheets. Let's say Larry had a plumber come in and fix a critical leak in the kitchen. The work is done, but the invoice hasn't arrived by the end of the month.
So he hasn't paid yet.
He isn't paid, he doesn't even have a bill. But his accountant must post an accrued expense. It's an accounting estimate for the work that was done. This recognizes the expense and the liability now, in the period it happened, to make sure the financial statements are accurate.
Okay, how does that possibly apply to us as individuals?
Think about your property taxes. You might only pay them in two big chunks per year, but your obligation to the city or county is accruing every single day.
I've never thought of it that way.
So if you're calculating your net worth on June 30th, you haven't received that second bill yet, but you absolutely have an accrued liability for 6 months of property tax that has to be estimated and included on your personal balance sheet if you want it to be accurate.
That really highlights the uncertainty. Okay, now let's talk about the scariest kind of uncertainty, contingent liabilities.
These are potential obligations that depend entirely on an uncertain future event. The classic business example is a pending lawsuit. A customer sues Larry's restaurant after a slip and fall.
And for an individual,
For an individual, this could be a major contract dispute if you're a freelancer, or it could be the failure of that co-signed loan we just talked about, even if it hasn't officially defaulted yet.
and what's the key difference in how these are treated compared to a regular liability?
It all comes down to probability. Management, or in our case you, has to judge how likely the negative event is. If the loss is deemed probable, and you can reasonably estimate the amount, you have to record it as a full liability on your balance sheet.
And if it's less likely?
If it's only possible, or if it's remote, it might only be disclosed in the footnotes of a financial statement, or just ignored entirely. The key here is that management's judgment about risk heavily influences what gets reported. It shows you the art that's inherent in accounting. It's not all just hard numbers.
That's a deep dive into all the things we owe. Let's complete the accounting equation now by talking about equity, the net assets of the owner. This is the number we're trying to grow. This is the goal.
Yes, equity is simply the residual value. It's what's left over from your assets after you deduct all your liabilities. It is your net worth. It represents the net funds that have been invested into your financial life, either by you or through growth.
We should probably break down the components of equity because the jargon changes depending on whether you're a person, a small business, or a giant corporation.
Okay, so the first source of equity is capital contributions. This is just the money the owners invest initially. If you're a sole proprietor, a one-person business, we just call that owner's equity or capital.
And for a big company.
If you're a major corporation, it's called shareholders' equity or stock. But it's all the same concept. It's the money the owners put into the business.
And the second component, which is the one that shows how your daily activities feed your long-term wealth, is retained earnings.
Retained earnings are just the accumulated profits that are held for future use. It's your revenues minus your expenses, added up over time. This is the growth that's generated by the business's actual operations.
And finally, those earnings are affected by withdrawals. That's money taken out of the business by the owners.
Right. For a sole proprietor, this is called drawings. They just pull money out for personal use, and the income tax is paid personally. But for a corporation, these withdrawals are called dividends that are distributed to the shareholders.
And the tax treatment is really different there, right?
It's a crucial distinction. Corporations often face double taxation. The company pays corporate tax on its profit first, and then the owner pays personal income tax on the dividend they receive. That's a huge consideration for business owners.
So when you link all these components, you can really see the expanded accounting equation in action. Your net worth isn't just a static number. It's constantly being fed by your cash flow behavior, your income, your expenses, and what you decide to withdraw.
And to tie all this knowledge together, we need that decision tree. We've established the asset test, and one of the questions was, how liquid is it? This brings us right to knowledge gap 2.
We've talked about illiquid assets, things like houses, rare art, a stake in a private business. These can make your net worth number look huge on paper, but if you can't get cash quickly to handle an emergency, that high net worth means very, very little in a crisis.
Liquidity matters more than your total asset value in the short term. The sources all highlight that there's usually an inverse relationship between liquidity and return.
Meaning what?
Meaning less liquid assets often have to offer a higher potential return. It's called a liquidity premium. The investor is being rewarded for taking on the risk of not being able to sell quickly.
So what's the takeaway for the listener?
The takeaway is that you need a safety layer. You need a buffer of high liquidity assets, like cash in a savings account, to protect your high return illiquid assets. You can't be forced to sell your house in a down market to pay for a medical bill.
And the liability test on the other side requires asking those really tough questions. Especially, does this liability grow if I ignore it because of interest and fees? And is it tied to a good asset?
Right.
If I have a mortgage, is the potential appreciation of the house worth the rapid growth of the interest and all the ongoing costs?
That holistic view, looking at the asset and the liability as a pair, is essential. You have to evaluate them together, always. Okay, now let's see how all this theory plays out in 2 really concrete, real-world scenarios.
All right, so we've got 2 fictional people. They both have a very similar net worth on paper, but they are living completely different financial realities. This perfectly illustrates that whole net worth versus cash flow dilemma that we introduced right at the top.
Let's start with case study 1. Looks rich, feels broke. This is the cash flow trap. This is the person who prioritized getting a large, impressive-looking asset, but now has very low liquidity and incredibly tight monthly cash flow.
Let's look at their balance sheet. Total assets are $317,000.
Sounds pretty good.
Sounds great, but it's almost all anchored by the home's value at $300,000. Then they have a car with a resale value of $12,000 and only $5,000 in liquid savings.
Okay, now for the other side. Total liabilities. $296,000. This includes a massive mortgage of $280,000, a car loan of $10,000, and $6,000 in high-interest credit card debt.
So the net worth calculation is $317,000 in assets minus $296,000 in liabilities, which equals $21,000.
And the implication here is, frankly, deeply concerning. All their wealth is tied up in one massive, illiquid cash flow negative asset. Their entire monthly life is dominated by that high mortgage payment, the taxes, the insurance, and that rapidly growing $6,000 credit card bill.
So if the washing machine breaks,
Or the property tax assessment jumps unexpectedly, they are immediately stressed. They have no buffer. They have to resort to more high-interest debt to cover that gap. They have high assets on paper, but minimal freedom in their actual life.
okay, now let's look at the complete flip side. Case study 2. Doesn't look rich, is building wealth. This is the power of liquidity. This person has much lower total assets, but they have strong control and really positive momentum.
Their total assets are only $31,000. But look at what those assets are. It's all in highly liquid or semi-liquid forms. They have $25,000 in investments and $6,000 in savings. They've made a choice to rent and use smart, lower-cost transportation.
And their liabilities.
Total liabilities are just $8,000, and it consists solely of a very controlled student loan balance. And here's the crucial part. They have zero high-interest credit card debt.
Okay, so the net worth calculation, 31,000 in assets minus 8,000 in liabilities equals $23,000.
Wait a minute.
$2,000 higher than the person with the massive house.
And the implication for their life is vastly different. This person has strong liquidity with $6,000 in cash. Their debt is controlled and manageable, and their positive monthly cash flow is constantly feeding their investments, which are themselves cash flow positive through capital gains and dividends.
They're on the right track.
They are set up for exponential long-term growth and far, far less financial stress, even though they don't have the visible assets of the first person.
This just affirms the final truth. Net worth versus cash flow. Your net worth tells you your long-term position, but your cash flow dictates whether your life feels easy and flexible or stressful and tight today. The goal has to be to improve both at the same time.
Grow assets that appreciate or provide you with income, and be absolutely ruthless about reducing liabilities that grow quickly.
And as we talk about growing assets, this is a good time to tackle knowledge gap 3. We use the rental property as a great example of a good asset, but what about listeners who don't have the hundreds of thousands in capital or the expertise to go out and buy physical real estate?
Yeah, that's a huge barrier for most people. The sources mention REITs, which stands for Real Estate Investment Trusts. These are often misunderstood, so we should define them clearly.
Okay, what is a REIT?
A REIT is basically a company that owns, operates, or finances income-producing real estate. But crucially, they trade on major stock exchanges, just like a share of Apple or Google.
So they're liquid.
They're very liquid. And because of U.S. tax law, they are legally required to distribute at least 90% of their taxable income to their shareholders every year, usually as dividends. This makes them fantastic sources of passive income.
So they let you diversify into real estate without the headaches of being a landlord, dealing with maintenance, or needing a huge down payment. But how does a listener choose between buying a REIT and just buying a standard stock if both can provide dividends and long-term appreciation?
The choice really comes down to a few things: volatility, tax treatment, and how they correlate to the rest of the economy. REIT dividends, for example, are often taxed as ordinary income, which can be a higher rate than the qualified dividends you might get from a standard stock.
And they're more sensitive to certain things.
Definitely. While REITs offer a great hedge against inflation because they own tangible property, their performance can be highly sensitive to changes in interest rates and the health of local real estate markets. They react very differently than, say, a tech stock would to the same economic news.
So the listener needs to analyze their own risk tolerance. Do they prefer the potentially tax-efficient capital gains from growth stocks, or do they want the high, consistent dividend payout and inflation hedge that comes with a REIT? It's a strategy decision.
Exactly. It's about building a portfolio that matches your goals. Okay, so we've provided the entire theoretical framework. Now let's get super practical. Let's give everyone the practical action plan, the simplified steps.
All right. Today, take 15 minutes. That's it. Don't overthink this. Just write down 3 numbers: your cash and savings balance, your total known debt, and your honest gut feeling guess as to whether your net worth is moving up or down right now.
And then pick one quick win, one tiny thing. Call and cancel one subscription you don't use. Pay off the smallest high-interest debt you have just to get it gone. Or set up a tiny $5 automatic transfer to your savings account. That immediate small action creates momentum.
Okay. This week, set aside 60 minutes. Now you're going to build your simple personal balance sheet and, most importantly, add that cash flow layer. List your assets, but be conservative. Use a realistic resale value, not what you wish they were worth.
And for your liabilities, list them exactly. Don't round down. Then add your detailed monthly expenses, and you have to calculate your true costs. That's your annual insurance premium, your yearly car registration, and estimate for repairs, all divided by 12.
Because those true costs are what separate case study 1 from success. They prevent unexpected emergencies from turning into new debt liabilities. Once you have that full picture, just choose one focus. Build your emergency fund, attack your high-interest debt, or increase your investment contributions. Just one.
And finally, this month, set one habit and automate it. Just one. Set one automatic system. It could be an automatic debt payment that's slightly above the minimum, or an automatic transfer into your investment account on payday. And remember the golden rule of wealth building. Automation beats motivation every single time. If you don't have to rely on willpower, it will actually get done.
Yeah.
Hashtag, tag, tag, outro.
This has been a massive deep dive into, really, the language of wealth. We've learned that paper assets can easily create cash flow crises, that the net worth equation assets minus liabilities is your ultimate scoreboard.
And that liquidity and being absolutely ruthless with controlling high-interest debt are just paramount to your success.
You now have the full set of lenses, the balance sheet and the cash flow, to analyze all of your financial decisions and to finally separate productive assets from just consumption costs.
But we want to leave you with one final provocative thought that ties all the way back to that idea of human capital. Your ability to learn and adapt, your human capital, is the greatest, most valuable, and yet unquantified asset you will ever possess. If that asset is constantly growing, generating higher pay and greater opportunities, it provides the fuel for every other asset you will ever acquire.
Whether that's a house or stocks or a REIT, it all starts there.
It all starts there.
So the question for you today is, what highly valuable, marketable skill are you investing in this month to generate the biggest possible dividend for your future net worth?
Invest in yourself wisely.
We'll see you in the next deep dive.